Good day. I am here to take you through our investments idea on 91 Limited. The group is trading at a market cap to assets under management of 1.22% compared with their European peer average of 1.92%, while on a PE basis it is trading slightly ahead of the same peers but at a slight discount to Schroders, who is the only peer with a similar emerging market presence. Total assets under management declined by only 7% during a period that included the COVID-19 sell-off, which is a testament to the appeal of its products. Fixed income rates are at historically low levels, and thus we anticipate higher allocations into riskier assets as clients pursue alpha generation. These riskier assets are often associated with higher fees, which should provide a boost to revenue. The group has a strong historical record of positive client cash flows, which is preferred over flow-driven assets under management increases, as these client flows are often more sustainable and reliable. With no debt, sufficient capital, and a significant portion of total expenses being variable, the group should be able to weather the current market storm and manage excess volatility. 60% of group earnings comes from outside of SA, providing protection against idiosyncratic risks, but does, however, expose investors to exchange rate risks. Based on a forecast assets under management level of £123 billion for the 2020 financial year and an applicable market cap to assets under management ratio of 1.54%, which we got by applying a 20% haircut to the peer average of 1.92%. We feel that the 20% haircut is warranted, given the perceived higher risk of emerging market assets, lower than average earnings yield, and the group's limited proven track record as a listed entity. The valuation comes to 303.41 pence per share, which as at 29 July 2020 translates to a 24% discount. The above valuation and aforementioned factors, combined with the above peer average forecast return on equity and forecast operating margins, as well as the higher than peer expected 3-year forward annualized growth in revenue and in EPS, we have an overweight recommendation for the SA equity portfolio. Regarding the income growth portfolio, the target dividend policy translates to an implied forward dividend yield of 3.6% for the 2021 financial year, and this is forecast to increase to 4.5% by 2023. In addition, depending on surplus retained earnings, the group will consider paying a special dividend. Further, the robust balance sheet and the steady, reliable cash generation, combined with historically strong client cash flows, should assist the group in sustainably growing dividends. As a result, we also have an overweight recommendation for the income growth portfolio. The group has a strong track record of growing assets under management over the past 29 years, providing stable and consistent earnings in the form of management fees, which makes up almost 75% of total revenue. The majority of assets are invested in equities, fixed income, and multi-asset classes. Geographically, Africa is the largest contributor to AUM at 35%, followed by the UK at 21%, Asia Pacific at 17%, 14% from the rest of Europe, and 13% from the Americas. As a result, the group has a strong and significant level of revenue diversification. 91 has seen strong inflows, with 2017 being the only year with a net outflow. Strong client cash flows is a preferred criteria when looking at asset managers, due to the flows being a more reliable source of recurring flow compared with market movements. Management provided the following outlook in the 2019 financial year results. Lower revenue is expected going forward. and as a result this will require cost discipline to mitigate the impact. Product relevance and investment performance will be key to ongoing success. The pandemic and market reactions have, however, created an opportunity-rich environment for alpha generation. The business remains resilient and stable with strategic clarity and an ambitious long-term growth agenda. Considering the strong emerging market presence in assets under management and revenue from 91, it is worth investigating the fundamentals of an emerging market ETF relative to a world ETF. While the emerging market ETF is trading above average levels relative to itself, it is trading below 9-year historical levels for most of the valuation metrics. This highlights potential alpha opportunities in the emerging markets where 91 has a strong presence, and this could support above peer earnings growth going forward. Before I end off, if you would like to trade, then please contact our trading desk. Investors are reminded that they can refer to our online trading platform, which contains a more in-depth analysis on the 91 investment idea. For more information on how to interpret the trade idea, visit the events section on psg.co.za to access previous trade ideas and how to understand the method of analysis we use. Lastly, I would like to bring your attention to the following disclaimer. Thank you very much.